Welcome to A Few Minutes with Marcia. My name is Marcia Clark. I'm the Senior Research Analyst at Warren Street Wealth Advisors, and we're going to take a couple minutes today to talk about yield curves, specifically inverted yield curves. And you may have heard about these inverted yield curves in the news in the past few weeks, that if there's an inverted yield curve, then a recession might be coming. So what's a yield curve and how can it predict a recession? That's what we're going to talk about today. So first, a yield curve. It's just a graph. It shows what interest rates are offered at different points of maturity. So there's maturity dates on the horizontal axis and interest rates on the vertical axis. So all it does is just graph what interest rates are investors demanding to lend money for longer periods. So you would expect they're going to want more money to lend for a long time and not so much to lend for a short time. And so the yield curve would normally have an upward slope. Longer time, more interest. An inverted yield curve is the opposite, and that's what makes people nervous. You see short-term rates at 6.2. In this case, this is back from September of 2000, and long-term rates at 5.6. Like, what is going on there? Why would investors accept less money for investing for longer? Well, something strange is going on. What's normally going on when that happens is the Fed is doing something with monetary policy. That's shifting the short-term part of the curve. And the long-term part is responding to supply and demand, which can sometimes get out of sync. Where we're at now, we have a flat yield curve. We have short-term rates around 2.4, long-term rates at about 3. So not very much difference, and people are getting nervous, and rightfully so. But why do we have a flat curve? What's happening today? Well, the Fed is definitely active in the marketplace. Since, if we go all the way back in time, in the mid-1980s, we had short-term interest rates very high, 17.5% or higher, as we're fighting off inflation threats back then. And we get this inflation under control, and we kind of stabilize here in the mid-90s at around 5 or so, 4.5% to 5%. We've got a dot-com crash. We have to reduce rates to fight a recession there. And then we have the 2008-2009 recession, where we end up at 0 for a long time. So the Fed is active in the marketplace trying to keep us out of trouble. Now, we can't stay at 0 indefinitely. So the Fed has to get us back to normal, and that's what they've been doing over the past couple of years. Take us from 0 to 0.5 to 1 to 1.5, and now we're at between 2.25 and 2.5% on the short-term rates. That's still not very high compared to all of this history. So they're still not quite at normal, but they're getting there. And so that's what's happening with the short part of the curve. Now, is that really predicting a recession? Well, let's see why people think so. Here we have an inverted curve when the blue line goes below this 0 line, which is black, and here's recessions in these dark bars here. So 5 recessions, each of which has been preceded by an inverted curve. Okay, so there's definitely some correlation there. But if we look at these curves closely, when they invert here, there's a couple of years before this recession actually hits. And if, in fact, the yield curve goes back to normal before the recession hits. Same thing here in 2000. It's back to normal before the recession, and here again in the 2008-2009 period. So is it predictive? I'm not really sure. We're headed that way. That's why investors are concerned and commentators are concerned. But let's think about really what's going on. Is it prediction or just coincidence? So how are we going to figure this out? Well, let's take a look at the longer term interest rates and see if that helps understand. On the long term, these rates, this is the 10-year treasuries on the red line here, and the S&P 500 is on the blue line here. Those longer term rates respond to supply and demand. They don't respond to the Fed. It's the willingness of borrowers and lenders to make an arrangement. So what we see in the last couple of months is the stock market's been very choppy. It's up and it's down, it's up and it's down, and these big swings in the stock market. And investors are getting tired of that. They don't know what's coming next. They're not very comfortable. They can't sleep at night. And after a while, they just can't take it. So they sell their stocks, and what do they buy? Well, they buy something safe, and that would be U.S. Treasury bonds. So what you see here is the yield on U.S. Treasury bonds. It's just going off a cliff here in the last bit of November and into December because of demand for those bonds. So when the demand for something goes up, the price goes up. And if the price goes up for bonds, the yield goes down. So this dynamic here is keeping those long-term rates low, even when the short-term rates are going up. So that's what's causing this flat yield curve, which could in fact become inverted, but not for reasons related to the economy, but for reasons really related to the stock market, which are not necessarily the same thing. In fact, if you look at corporate bond yields, you can see that those rates are actually going up with the Fed, where you have a normally sloped curve. And that's because there's no flight to quality here with corporate bonds like you see with treasuries. So if you do look at the corporate bond yields and you see a normal curve, maybe that's what we should be referencing as far as inverted or normal, and not so much the treasury curve, which is what we usually talk about in the news. As it turns out, corporate profits are strong. Employment is good. We don't really have a reason to think the economy is going to slow down in 2019 and maybe not even in 2020. As long as the data is strong, we think you should just hang tight. We are. So at Warren Street Wealth Advisors, we're looking for the numbers. We're watching the data. We want to see actual evidence that there's a recession before we go running for the hills. So we've kept our investments in areas of the market we think provide value. And it may take a while for that value to be realized, and we'll have to ride out some bumps in the road. But ultimately, we feel like if we hold tight that we're going to end up where we want to be. So that's what we're doing. And we hope that you'll hang out with us too and ride through the turbulence with us. If you're interested in getting more information about this, there's really good articles in the Wall Street Journal. Here's one on this slide that I like. And also you can get a primary data right from the source. You can get it from the St. Louis Fed. They have a lot of great economic data. So this has been Marcia Clark, Senior Research Analyst at Warren Street Wealth Advisors. If you have any questions, I hope that you'll reach out to me. You can just send me an email at marcia@warrenstreetwealth.com, and I hope to see you again soon.